Price is what you pay, value is what you get. That's a quote from Warren Buffett. A company's valuation is like a big price tag. It's what somebody would have to pay to buy it today.
Investing starts with a simple idea. You buy something because you think it will be worth more later. But here's the catch. Getting a good deal can greatly affect your returns. Pay too much and you might not make as much as you hoped.
This is your guide to stock valuation. We'll start with simple steps. We'll walk through the tricky stuff together, and by the end, you'll understand how to value a stock. So let's dive in. Hey there, I'm Stephanie, tech veteran, engineer, and creator.
And I'm Bertrand, founder of App Economy Insight.
Think of a company as an apple tree. The value of the tree isn't just based on the juicy apples hanging on it today. It's also based on the apples that it'll grow later. The same goes for a company. It's not just about the money it's making now, and it's also about its future profits. This is its intrinsic value. This is just a fancy way of saying, all right, what is it really worth? Based on what we can expect in the future. That's what drives a company's worth in the long run.
Investing is all about the future, not the past or the present. Predicting the future, though, is not easy. How long will a business last? Will it grow over time? Nobody can say for sure. That's why company valuations are subjective.
Right. Buyers and sellers set stock prices. They might have different ideas about a company's worth. In the short run, things can get a little bit crazy. Prices can shoot up or down, not reflecting a company's worth. But in the long run, the value of a company follows its earnings power.
The market cap is a key metric, short for market capitalization, representing the total value of a company's stock. Think of it as a company's price tag. The market cap formula is equal to stock price multiplied by the number of outstanding shares. A low stock price doesn't necessarily mean a bargain. You must consider the market cap to understand the company's overall value.
Another important term is enterprise value, which strips out the company's cash and debt from its total value. Enterprise value equals market cap plus total debt minus cash. In short, a net cash position adds value while a net debt position detracts value.
For a thorough understanding of a company's value, various tools serve as your measurement yardstick.
Price to book, or PB ratio, compares a company's market cap to its book value, assets minus liabilities. Think of it like valuing an apple tree based solely on the trunk and the branches while ignoring the present and future apples. Often, a company's market value exceeds its book value due to its earnings potential beyond its assets.
Next, we have price to earnings, or PE for short. It compares a company's stock price to its annual earnings per share, or EPS. It tells you how long it would take to get your money back, assuming the earnings stay the same. But remember, businesses change and markets swing. Earnings are rarely ever constant.
Next, price to earnings growth. PEG ratio refines the PE ratio by factoring in expected growth rates. PEG ratio equals PE ratio divided by growth rate.
Next, we have the discounted cash flow analysis, or DCF for short. It tries to value a company based on future cash flows. It's like assessing a rental property based on future rental income.
Reverse discounted cash flow, reverse DCF, is DCF, well, in reverse. It's like figuring out how much rent the market expects you to collect based on the current property price. It gives you a sense of market expectations and if they seem fair.
Each method has pros and cons, and none gives the complete picture. Think of them like different tools in a toolbox. A hammer might be great for some jobs, but you might need a screwdriver or a pair of pliers for others. Let's review why these ratios can be misleading, if not entirely useless.
So think of a business like a living thing. It's born, grows, matures, and eventually slows down and dies. Understanding where a business is in its life cycle is critical when evaluating what a company is worth.
In this visual, I borrow from Brian Feroldi, and I illustrate where some well-known companies currently sit in the 6 stages of their life cycle.
So startup, if the company is still unprofitable, there are no earnings and therefore no denominator. PE and PEG are useless. The value often depends on an exit strategy, like an acquisition or IPO. For example, OpenAI.
Next, we have the hyper-growth phase, when a company reinvests aggressively in the business and focuses on growth. Earnings are suppressed by design. The value depends on the long-term earnings power and the durability of the growth. A great example right now is snowflake.
We have self-funding. The company is just breaking even. Any valuation based on earnings remains, well, useless still. Management is usually still reinvesting in the future growth and fine-tuning its business model. A good example of this would be Uber.
The next phase is operating leverage. It's when a company is expanding its margins through scalability and efficiency. In this stage, revenue grows faster than operating expenses. PE and PEG usually remain misleading if there is room for improvement. A great example right now would be Salesforce.
Maturity. These are the stalwarts. They have a steady, predictable business with normalized, predictable growth. The PE ratio here is useful. So an example of this would be Visa.
And finally, we have the decline phase. When revenue and earnings start declining, the PE ratio becomes artificially attractive. Why? Because if earnings, the denominator, continues to drop, the PE ratio will rise. Most valuation metrics based on trailing earnings become useless. A great example right now would be Bed Bath & Beyond. Turnarounds are always possible, but they are rare.
DCF models are popular for estimating a business's intrinsic value. So think of it like guessing how much rent a house might earn over time to determine its value. Things can change over time. Will the neighborhood stay popular? Will repairs be needed? DCF models rely on forecasting a company's future profits, which is just as tricky. One wrong guess and the entire valuation is off.
DCFs use factors like discount rates to adjust future value. Tiny changes here can cause big swings in the final number. It's like trying to hit a moving target.
DCFs assume steady growth, but what about new rivals or tech disruptions? These models don't often foresee those shifts.
On top of that, DCFs have a terminal value and estimate all future profits beyond a set point. It's like guessing your rental income decades from now. Analysts struggle to predict the next quarter, let alone the next decade.
DCFs can help you understand what needs to go right for your investment, but don't fall in love with a spreadsheet.
If you like this video so far, yes, we are going to ask, smash that subscribe button.
Right, it might not seem like much, but it really helps our videos be discovered for us to keep bringing you more content around tech, business, and investing.
Industry peers and other benchmarks is one of the best ways to value a company.
Identify comparable businesses. Select companies in the same sector with similar business models and market capitalization, like comparing Nike to Adidas and Under Armour.
Examine key metrics. Look at customer metrics, growth rates, and margins. Superior fundamentals could justify a higher valuation. Investigate past performers. Review companies with similar past fundamentals. If reviewing a fast-growing tech startup, maybe consider previous firms at a similar growth stage.
Benchmark against the market. Consider broader market and economic conditions. So for example, most stocks are cheaper in a bear market, so our expectations change.
And account for sector trends. Identify trends such as e-commerce shifts impacting brick-and-mortar retailers.
Assess the valuation spectrum. Recognize that a company's valuation shifts as it matures. It often grows into its valuation as earnings appreciate over time, but occasionally offers more attractive entry points.
Nassim Taleb explains in his book Anti-Fragile, optionality is the property of asymmetric upside, preferably unlimited, with corresponding limited downside, preferably tiny.
Right. Investing is a game best played when the upside potential significantly outweighs the downside. The downside risk is to lose 100% of the capital invested, but the upside? It can be a lot more than 100%.
Companies with multiple shots on goal or various bets for future growth often command a higher valuation. Think Amazon, whose online bookstore has become a cloud computing giant and a media conglomerate.
Optionality can also serve as a protective moat. Companies that can pivot or tap into new markets have a safety net if their businesses face challenges. Google's diversification away from search through YouTube, Android hardware, Google Cloud, and other technology bets provides a margin of safety.
Optionality is challenging to pinpoint accurately and subject to debate, but often it's very characteristic that grants the best businesses a higher valuation than their peers.
Many elements can affect a stock's value beyond the business. Think of a business as a car.
Right, so we have management quality first. Like a skilled driver, an efficient, visionary management team can navigate the company through adversity, maybe make strategic decisions and enhance shareholder value. Their leadership style and track record can significantly influence investor sentiment and the stock.
Economic environment. Like road conditions, economic variables like interest rates, inflation, and GDP growth can significantly sway a stock's value.
And then we have investor sentiment comparable to unpredictable weather conditions on the road. Investor sentiment can be bullish or bearish and impacts a stock.
and market trends like traffic signals and road signs. Trends like changes in consumer behavior, technological process, or regulatory shifts can shape a stock's value. So in short, don't look at a valuation in a vacuum. Very large returns require investing for the long term. The longer you hold, the less exact entry point valuation matters. What's more crucial is the investment selection and how long you stay invested.
Howard Marks often mentions the trap of mean reversion, the notion that what comes up must come down and vice versa. This concept can drive investors to sell prematurely, securing small gains and hunting for the next underpriced stock. This relentless quest for low valuations can result in a portfolio filled with average businesses.
Right, and to quote Buffett, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Remember, in investing, just as in life, well, you often get what you pay for.